Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did. Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And you don't forget it.
Welcome to another edition of Talk Money. I am Jeffrey Shank, a chartered financial consultant and owner of Andover Advisory Group, a registered investment advisor. And for over 25 years, we have provided effective financial advice to individuals and businesses. Thanks for tuning in. Our mission here on Talk Money is to improve your money IQ. And Lou, good morning.
Good morning. How are we doing today?
Very well, thank you. Along those lines, improving your money IQ.
Mm-hmm.
We're going to test that today.
Oh, I got another test. Excellent.
We got a quiz.
I love
a quiz.
I love getting up the quizzes on Monday morning.
And you will be representing
great.
all of our audience.
All right.
Not to put any pressure.
No, none whatsoever. All good.
We got some good things lined up today. In addition to the quiz, we have this question we get asked a lot. Should you prepay your mortgage? And so we're going to examine whether or not that's a good idea to prepay your mortgage. And then we've got this week's Talk Money tip, of course. And that's a good one too, I think. Actually, it's a follow-up from last week.
I know we're going to get to that down the line, but prepay, like pay it off, or just pay on principal after you pay the interest payment?
Right, exactly.
Oh, all right, excellent, good, interesting discussion.
Yeah. So, but let's get right to our quiz, shall we?
Sure.
And Lou, I just want to say that
right off the bat, good, no warm up.
I just want to say, if the student didn't learn, the teacher didn't teach. Okay.
Okay. Sure. All right.
So again, no pressure.
Did you watch the Patriots yesterday? That's all I'm saying.
I didn't get to see the all of the game. I was busy. I was working on a project, but I did get to see a lot of it. And when I tuned in the first time, they were already down by a couple of touchdowns. Yeah. So
yeah, well, the teacher didn't teach,
look good.
The student didn't learn. There's a lot of stuff going on.
So today's quiz is all about retirement plan rules.
Okay. And
so we're asking the question, how well do you understand retirement plan rules? So we'll get right to it. First question, number one, right? You can make an unlimited number of retirement plan rollovers per year. Then you have multiple choice.
Sure.
True, false, and option C is it depends.
It depends. Well, see, it's always it depends. The answer is always it depends. Unlimited?
You can make an unlimited number of retirement plan rollovers. So let me just qualify this, okay?
Yep.
Qualified retirement plans include IRAs and 401k plans. So individual accounts as well as employer-sponsored accounts. So I should make that point. Okay.
I'm a little thrown by the word unlimited, so my first impulse is false, but I think it depends.
Well, you can't choose more than one.
I didn't choose one.
Can you say? So your last answer is the answer you're choosing. It depends.
Mm-hmm.
Correct.
Yeah.
But do you know why?
Because it depends.
Well, yes, this is
I'm
true.
sure there are set of circumstances under which
Show your work. Show your work, Lou. Show your work. I want to see. Want to see
Really?
you know.
Really, I got it right. Can we just go with that?
Okay.
Yeah.
So let me explain.
Yep.
Right. So rollovers can be made in one of two ways: through a direct rollover, what they call a trustee to trustee transfer, where you or custodian to custodian transfer, where the funds essentially you never touch them; they go directly from one custodian to another custodian. All right.
Yep.
Also known as a trustee to trustee transfer. Right. And so you authorize the funds to be transferred directly to another account. And the rollover rules, those transfer rules, have become very liberal in recent years. So used to be you could only roll money out of a 401k into an IRA, for example, or 401k to another 401k. But today, you can roll money out of a 401k into an IRA. You can take it and put it back into your 403b if you're working for a nonprofit.
Mhm.
You can pull it back out of the 403b and move it over to your 401k for your new employer. Put it back into an IRA and then roll it back over to a 401k plan. So the rollover rule essentially is this: that you can roll over qualified plans without restriction as to the number that you roll over within a year. A qualified employer-sponsored plan, unlimited number of rollovers,
Mhm.
and that would include from an IRA. So you can take an IRA, transfer it you can roll it a 401k into an IRA, take that, roll it into your employer's plan. If you lose your job and you roll it back into your IRA later on that year, you can take it and put it in your new employer's 401k plan. There are no restrictions as to how many times that you can do that. But there is a restriction on the number of times that you can roll over money from an IRA to another IRA.
Yeah.
Indirectly. So I said there's two ways that you can do it: trustee to trustee transfer, and the other is what they call an indirect rollover, where you pull the money out, you actually touch the money, and within 60 days, as long as you do it within 60 days, you put that into another retirement plan. So there is a restriction because of a recent clarification of the rules and the regulations on rollovers. You can only do one of those indirect IRA to IRA rollovers once every 12 months. Not once in a calendar year, once every 12 months. Correct. Yeah.
Yeah, see, the unlimited word was key.
Yeah, I think that caused you to go with the depends
Right.
answer, right?
Nothing is unlimited, Jeff.
Yeah. except for the federal treasury.
Yeah, maybe. We'll see.
The amount that the federal government can spend, totally unlimited. Okay, so that answers that's question number one. Any questions on that? Did I?
Nope. I think you did very well.
Okay, all right.
So if it's trustee to trustee, it's unlimited. If it touches your pocket in between, there are some limits.
If it's an IRA to IRA, but you can go to a 401k from an IRA more than once in a 12-month period. Okay.
Yep.
IRA to a qualified or employer-sponsored plan, you don't have the same kind of limits.
Okay.
All right. Question number 2.
Yes.
If you roll money from a Roth 401k to a Roth IRA, you can take a tax-free distribution from the Roth IRA immediately as long as you have reached the magic age of 59 and a half. Do you want me to repeat that?
No. So the question is whether there is a waiting period once you do a rollover from a Roth 401k to a Roth IRA. And I'm going to go with no. You can take out the money immediately.
The answer is, it depends.
It depends. Oh, wait a second. I didn't wait for the multiple choice.
So what was your answer? Your answer was false, right?
Yes.
You said you had to wait.
No, I said you could take it out immediately.
Immediately.
Period. Yeah.
Okay, so you said true.
Yes.
Okay. All right. So no, the answer is C. It depends.
It depends. It's always it depends. If there's an it's depends option, That's always the answer.
All of these have an it depends option. And so let me just tell you that they're not all C.
Okay.
Okay?
Thank you.
All right, you're welcome.
Yeah.
Beware of the 5-year rule
Oh,
as it applies to Roth IRAs. If you establish your first Roth IRA with your Roth 401k rollover dollars, you will have to wait 5 years, regardless of your age, to make a qualified withdrawal from the Roth IRA,
oh, interesting. Yeah.
regardless of how long you've held the money in the Roth 401k account. Even if you are over 59 and a half.
Mm-hmm.
You've already met the 5-year holding requirement with any Roth IRA, you can make a tax-free qualified withdrawal. And a qualified withdrawal would typically be one that's taken at age 59 and a half or older. But there are other ways to pull money out of a Roth account on a qualified basis. For example, you need money for your kids' college education.
Yep.
Right. Within limits. Right.
See, I didn't think about the 5-year waiting period for a startup, so that would have cost me thousands of dollars. Well, not with
Potentially.
but yeah.
Potentially, that's right. And so here is this is exactly the reason why, as one of the things that we do recommend to our clients, almost routinely, if it's appropriate for their particular circumstances, is to establish a Roth IRA as soon as possible.
Right.
Because you start that 5-year clock.
Right. Even like a $50 IRA. Just start it. Just get it started.
Just get it started.
Yep.
Put some money into it. And as long as you are 18 or older and you have earnings from any job, W-2 basically, right? Or maybe even self-employment earnings, you can put money into a Roth IRA. So start it as soon as possible. You get that 5-year clock started.
Mm-hmm.
And it could come in handy if you're rolling over your 401k and you want to take some money out on a qualified basis, right?
Yes.
Okay. Question number 3.
Yes.
You can withdraw money penalty-free from both your 401k and IRA, Roth or traditional, to help pay for your children's college tuition or to pay for health insurance in the event of a layoff. The choices are A, true, B, false, C, it depends.
Yeah, see, you screwed me up by telling me it's not always C. When isn't it? It depends. For student aid, for student tuition, and for health insurance if you've lost your job.
In the event of a layoff, correct.
In the event of a layoff. I'm going to go with that's true.
And the answer is false. Sorry.
False.
Yeah. Lou, by the way, there's only 4 questions.
Okay, so I'm
Sorry.
like the Patriots right now. Could go 1 and 3
You
in my first 4.
good point. All right. So
the second one, not true. You can't pay for your health insurance.
So you can take penalty-free withdrawals from an IRA, but not from a 401k to pay for a child's qualified education expenses.
Oh, I see. Okay.
Or to pay health insurance premiums in the event of a job loss. Only from an IRA, not from a 401k.
Yes, I'm not listening well.
These are not easy.
No, they're not. But
they are kind of important because a lot of these circumstances do arise.
Plus, it's a good tip that when the government hasn't got its tax cut yet, it can be very tricky getting money out of these things. So that's the distinction here, whether the government has its tax cut or not already.
You bring up a good point.
Mm-hmm.
You bring up a very good point. We might have a bonus question.
Okay.
I'll have to formulate it. Hopefully.
Give me a chance to get even if I get the next one right.
Give you a chance to get even, yeah.
Actually,
yeah, exactly.
I can go 2-2 if I get the next one right.
Yeah, that's a 50. Are we grading on a curve? You might end up with an A. All right. So looks like last question.
Yes.
Right? Okay. If you retire or otherwise leave your employer after age 55, you can take penalty-free distributions from your 401k plan. You can't do that if you roll 401k assets into an IRA. True, false, it depends. I'll repeat the question. I know this is critical. This is an important one. So if you retire
yes,
or otherwise leave your employer after the age of 55, or once you reach age 55, let's say, you can take penalty-free distributions from your 401k plan. But if you roll over your 401k to an IRA, that is not possible.
Okay, I have to establish, is this an established IRA, or is this
Doesn't matter.
a new IRA?
Doesn't matter.
Oh no, you have the 5-year look back period.
No.
No,
No.
No?
That was specific to Roth.
specific to
That
Roth.
was specific to Roth. And by the way, if you roll your 401k into a Roth IRA, you expose the money that that has been deferred. Any funds that have been deferred, your contributions, any growth, you expose that to taxation in the year that you roll it over. So what we're talking about here is penalty-free distributions from a 401k plan. So what is it? Let's before you answer the question, let's define what we mean by penalty-free distributions. Right. Okay. So if you pull money out of a retirement account, IRA, for example, and you are not 59 and a half, that's considered a premature distribution.
Right.
And you are taxed on it, and there's also an additional 10% excise tax, what they call a penalty, right?
Yep.
And that would be true of a 401k plan. And what this is saying, what this is asking is, simply put, can you pull money out of a 401k at age 55, penalty free? Can you pull money penalty free out of an IRA at age 55?
Well, wait a second. The question seems, I hate to...
If you retire or otherwise...
Nits here, but it says, this question states as a fact, you can pull it out of a 401k. It's asking whether you can...
It says if you leave your employer after age 55,
mm-hmm.
you can take penalty-free distributions from your 401k plan.
All right,
you can't do that if you roll over the 401k. They're asking you if that's a true statement, a false statement, or it depends.
Yeah, I'm going to go false.
The answer is
true.
True.
I didn't understand. I've never heard that you can withdraw penalty-free funds at 55 from anything, regardless of what's going on. So I didn't know that existed.
And most people don't know that. If you leave your employer, see, here's what happens when you leave your employer and you got a 401k balance. By the way, if it's less than $5,000, most employers will ask you to take your money.
Yeah.
They used to, because they just wanted to get rid of the administration cost and nuisance, right?
Yeah.
They wanted to get. They used to tell you, hey, you got to roll this money over. Today, because the custodians would rather keep that money in their accounts and collect the fees that are associated with that.
Yeah.
They encourage people just to leave it there. You can roll it over if you want, but they kind of say, hey, you can leave it. So a lot of employers will allow you to leave your 401k balance with them after you terminate your service.
Mm-hmm.
And one of the rules in most 401k plans is this ability, once you reach age 55, to withdraw from your 401k after you terminate your employment. You have to terminate your employment, right? Allow you to pull it out without a penalty, as if you were age 59 and a half.
You still pay the taxes.
You still pay the taxes. You don't pay the penalty.
Right.
Correct. And if you roll it over to an IRA, going back to our first question, and then pull the money out, guess what? 55 doesn't apply. It's 59 and a half.
Oh.
Yes. And so I actually have a slide because this is kind of important. This is an important message for anybody who has a 401k plan, whether you're close to retirement or you're getting ready, you got laid off and you're going to need some money in the short term because you haven't found new employment. This is really, really important. And so, all right. So this is the source of funds for new traditional IRA accounts
mm-hmm.
that are being opened up. This is based on 2016 data.
Interesting. Yeah.
84% of all new IRA accounts are opened with
Rollovers.
rollovers from existing qualified plans,
Hmm.
not new contributions. Only 3% a combination of new contributions and rollovers. And I assume, and I don't know for sure, but I assume that that's rollovers from other plans.
Right.
Why do you think, why are people rolling over their money from one account, like an employer account, to another account, new account?
It's a recognition of the changing tax landscape, isn't it? Because the after tax, the pre-tax contribution doesn't have the same effect and strategy that it did in previous, right? We do tax-free contributions to retirement plans because we assume we'll pay less taxes as we get older, but I think that assumption is...
We're talking about new accounts being opened up.
Yeah.
What's the source of funds? Primarily rollovers, 84%, and most of those have got to be from qualified plans, from
Right.
employer-sponsored plans. Why is that? Why are people doing that? Well, first of all, if you're terminating your employment, you think you might want to have more control. You might have more control over your account, or you don't like your employer fired you, so you don't want to leave any money there. I hear that all the time. People are saying, I'm getting the money out of there because they think that somehow the employer is making money off of this,
Right.
this account, and they really aren't, right? So they, I don't want to leave any money with them. I worry that they might go under, and I want my money. And the fact is that your money is separately accounted for. It's not part of the company's assets. You really can't invade it, so
Right.
you don't have to worry about that. So people are rolling that over for one of several reasons, but primarily because they think they're going to be better off by having a different account. And a lot of times that is coming from advisors who are saying, "Oh, let's roll over that money."
Oh, okay.
But
Yep.
get back to question number 4. There could be circumstances where rolling that money from your 401k to an IRA would be detrimental. Because now, especially if you get laid off and you need some money, you have to access your retirement account. If you pull it out and you're 55 or older, you're not 59 and a half yet, and you pull that money out of your 401k, there's no penalty. Still taxable, but no penalty.
Right.
But if you roll it over and then take it out, and you're not 59 and a half, guess what? Penalty. By the way, the same thing applies to an inherited IRA where a spouse inherits their spouse's 401k plan.
Yeah.
If you roll it over, you can roll it over into your own account. You can take it over as your own account. But if you roll it over and you're not 59 and a half, you pay a penalty. If you just withdraw it from the 401k or you set it up as a beneficiary account and pull the money out, then there's no penalty if you're not 59 and a half. So unfortunately, a lot of folks get bad advice and are rolling over money when they probably shouldn't be because of their circumstances. And this is just one reason. You can avoid the penalties if you don't roll it over, depending on your circumstances.
The overarching lesson with all of this is don't do this at your kitchen table. Don't
Right.
do it. Don't do it through Google. Yeah. Don't search answers for this stuff. You wouldn't take out your own appendix.
Well, the fact is that you will get some of these answers if you Google it.
Yeah.
The problem is that a lot of times those Google requests turn into ads, and the next thing you know is roll over, and you get several offers to roll over your 401k plan.
Right.
But if you do search hard enough, you'll find it. And so the problem is you get all of these potential answers. Which one is correct? Should
Right.
you or shouldn't you? That's where I think a professional advice can help you make that decision.
And again, mistakes with these assets can cost thousands of dollars. It's something you shouldn't take lightly.
Yes.
You shouldn't do impulsively.
Yeah. The other one, by the way, is conversions to Roth. I see that a lot where it just doesn't make a lot of sense for you to convert to a Roth, but people do it, and a lot of times it's because they're being sold on it, not because it's a good thing to do. So, yeah. So, Lou, I'm sorry to say, and I hope that doesn't reflect the audience as a whole. And
That's why we're all here,
and
Jeff.
I'm sorry. We don't have a bonus question. I
Well-
apologize. We don't have time for a bonus question.
Again, I'd probably fail a pop quiz on surgery too. So that's why we're all here talking to professionals,
Okay.
right?
Yes. Hey, so we're going to take a quick break, and then when we come back,
By the way,
we're going to.
I think it's a good point to mention here.
Sure.
You do have a free consultation that people
Yes.
can take advantage of, and it's a working consultation. In other words, if this is a specific question you have about a rollover of one of these assets or some maneuver you want to make with one of these assets, this is a good excuse to give you a call, get that
Yes.
free consultation.
Yes.
You'll give them some actionable advice on this.
Yes, and we can do that via Zoom. So real easy to do. All right, so we're going to take a quick
And
break.
there'll be no quiz.
There will be no quiz.
He'll just help you out. He will not quiz you at all.
Why, was that painful? Is that what you're trying to say?
Yeah, no, it was kind of
Okay.
embarrassing, actually.
Oh, sorry. All right. When we come back, we're going to try to answer the question whether or not you should pay off your mortgage early. So please stay tuned. We'll be right back.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back. Lou, owning a home, it's the American dream, right?
Yes, it is.
But most cases, that comes with a mortgage.
Most cases.
Most cases, that comes with a mortgage, right?
Yeah. Yep.
And one of the questions I get asked frequently, especially those clients who are getting close to retirement and thinking about retirement and what that all looks like, right? Is paying off the mortgage, and should I do that? In fact, that's one of the top 5 goals of clients when we go over their financial plan. But competing with the desire to own your own home free and clear is a need to invest for retirement,
Right.
your child's college education, or some other goal. And putting extra cash toward one of those goals may mean sacrificing another. So how do you choose?
Mhm.
Now, deciding between prepaying your mortgage and investing your extra cash, it's not really easy because each of those options does have advantages and, of course, disadvantages. But what you can do is you can start by comparing what you'll gain financially and what you'll give up. And in economic terms, we call that evaluating the opportunity cost.
Okay.
So here's an example. Let's say that you have a $300,000 mortgage balance, 20 years remaining on your 30-year mortgage, and you're paying 6.25% interest. And I know that's high by today's terms, but there still are some folks out there that have that kind of an interest rate.
Yep.
And so for purposes of our example, we're gonna use that number. If you were to put an extra $400 each month towards your mortgage, in other words, the principal and interest is X, and you're going to add $400 against the principal.
Right.
each month, you could save approximately $62,000 in interest over the balance of the 20 years
Sizable.
and
Yeah.
pay off your loan almost 6 years earlier, 14 instead of 20.
Wow. That is a big difference.
Yep. So sounds good, right?
Yes.
But what do you give up?
You give up the
That's what you
opportunity.
gain. What do you give up?
You give up the opportunity to put $400 a month into a retirement plan.
Right.
Yeah.
Right. So you're clearly gaining a lot. But before you decide to start doing that, you still have to consider what you might be giving up in the meantime. And essentially, it's the opportunity to potentially profit even more from investing that money, as you just said.
Right.
And you said into a retirement plan. There could be a lot of different ways you can do that, right? So how do we decide what? And by the way, I usually explain this to my clients by telling them that I look at it from a clinical perspective, right? I say, hey, look, here's the opportunity cost. I've evaluated the opportunity cost for you, but there is some psychic value to having that mortgage paid off or knowing that you'll have that mortgage paid off earlier.
Yep.
And we can't discount that, but I can't put that in there. And really it becomes a lifestyle decision. And that's where I can't advise you as to how to design your life.
Yeah.
You have to make those decisions.
There's some peace of mind and satisfaction going into
Right.
retirement without a mortgage payment.
Exactly.
Yep.
Right. Yeah. So what we have to do is have to look at the after-tax. First, we have to look at the after-tax rate of return you can expect from prepaying your mortgage. If you do itemize your deductions, you generally pay less. The cost of paying your mortgage is less than what the interest rate is saying because you get to deduct that interest, and that reduces your tax burden. So you have a net cost after taxes if you're itemizing your deductions. Does that make sense?
Yes.
Okay. So it might not be 6.25%. Let's call it 6% just for to make it easy. It might be 5% because you're deducting that 6% of interest, and the government basically is subsidizing that cost, and it might be 5% instead of 6%. So now what you have to do,
that
right?
Additional interest has some relief on your tax burden.
Correct.
Yep.
And so it's a net, so that you have to calculate the after tax, the net cost after you factor in the interest deduction on your income tax return, right? So now we have to compare that to the after tax return that you could receive by investing that money. You said immediately put it into a retirement account, right?
Or some sort of plan.
Well, a retirement account, think about this. A retirement account, in most cases, it's a pre-tax contribution. So You're not paying any taxes on it. That money is growing. 100% of it is growing. And any return, any profits are not being taxed currently.
Yes.
Eventually, you will likely have to pay some income taxes on it, or somebody will have to pay income taxes on it. So you have to keep that in mind. But in the retirement account, we don't necessarily, at least initially, have to factor in any tax. Now, if you put that money into a taxable account, we have to figure out the return you're going to get after taxes.
Right.
And what we're trying to beat in this particular example is 5%. So if you think that you can get a better than 5% after tax return on that money that you're thinking about paying towards the mortgage, there's your opportunity cost.
Right.
Right. If you all these goals are competing for your money.
Right.
You have to decide what's the best place to deploy those dollars. Right.
So is beating a 5% return realistic over the next 15 years?
That's the question you have to answer.
Yeah.
I'm not going to answer that for you right now, and we're using this is a hypothetical, so it kind of is not important to try to answer that now. But keep in mind that the rate of return you receive is directly related to the investments you choose, and investments with higher potential returns do have additional risk. So you have to take that into consideration, because paying down the mortgage is almost guaranteed.
Yeah.
Right? If you pay the principal, you know what the rate of return you're going to get by investing that money in your mortgage principal, right?
Right.
So points to consider: interest rate, right? The lower the rate on your mortgage, the greater the potential to receive a better return through investing. And what did I say? 6% is kind of high these days.
Yep.
A lot of folks have a 3% mortgage. It's hard to believe. It's historically low, but there it is. So do you really want to pay that off early?
Yeah.
Is the question. Can you do better with those dollars? And again, there is some psychic value, emotional value, and not having a mortgage, or at least knowing that you're going to pay it off sooner, right?
Right.
You have to consider whether or not the mortgage has a prepayment penalty. A lot of do. You got to be careful, right? But so don't start making those payments until you check.
Right. And the method and timing with which you make that payment is often important, right?
What do you mean?
Well, it seems anecdotally, I've heard stories of people trying to pay principal on a mortgage, but doing it incorrectly. In other words, it's not timed correctly, or I don't know.
No. If you make an extra payment, it should automatically go towards the principal, unless somehow your mortgage says that you're paying interest first, which makes no sense today. There were loans that did that. Generally speaking, if you make an extra principal payment, it will go. If you make an extra payment with your mortgage payment, it will go towards principal first.
Mm-hmm.
You should check with your servicer just to make sure that that's the case. Keep in mind, it's not reducing your next mortgage payment.
Right.
Your next mortgage payment is still due.
Yeah.
Your next mortgage payment is still due for the same amount. You haven't reduced the amount of your mortgage payments by making an extra principal payment.
How does age of the mortgage play into this? Because as we know, they front load interest payments. You're paying a lot more interest at the beginning of the mortgage than you are towards the end of the mortgage.
Generally speaking, a mortgage is amortized over the time period without any front loading of interest. So the interest that you pay towards the end is typically less than when you started. Why? Because your mortgage balance is being reduced.
Oh.
That's why.
Oh, I see. So they're not front loading mortgages.
No.
Oh, interesting.
No. Well, again, your mortgage could be different, but generally speaking, a conforming conventional mortgage, they don't have all those things that might have been in a mortgage in the past.
Mm-hmm.
Yeah. So, got to ask yourself how long you're going to stay in your home, right? So the main benefit of prepaying your mortgage is the amount of interest you save over the long term. If you plan to move soon, there's less value in putting more money towards your mortgage, right?
Yep.
Will you have the discipline to invest your extra cash rather than spend it, right? So
Yep.
we said, hey, look, don't pay down the mortgage, invest it. Well, what if you don't? If you're not disciplined, maybe making that extra payment on a regular basis gives you that discipline, and maybe you're better off doing it that way.
Yep.
Right. Do you have emergency funds? Do you have liquidity?
Yeah.
Once you make that principal payment, it's locked. It's locked up.
Right.
Unless you have an equity line that allows you to access that equity later on, it's there. You're not gonna be able to get it back out unless you refinance or, like I said, take out some sort of an equity line, right?
Right. Yep.
So and even though you might be okay now, how what about next year or the next crisis, financial crisis or other, that you might be unemployed for a period of time. So you want to make sure that you have, if you're going to do this, you have adequate liquid funds to cover those emergencies, right?
That would suggest, especially if you're a younger couple, that would suggest a investment as opposed to an IRA or a 401k or a Roth.
To give you that liquidity with the money that you're not putting towards the mortgage, you mean?
Right. Yeah.
Yeah. Okay. Yeah. So what I'm saying is that if you are taking your extra cash and prepaying the principal, that's not an emergency fund. You can't get that money back out. And so
right.
you might want to make sure that you have liquid assets enough to cover your, and they shouldn't be in retirement accounts, as you point out, Lou. You're absolutely right.
Yep.
Yeah. You have to ask yourself, how comfortable are you with debt, right? If you worry about it endlessly, then the emotional benefits of paying off the mortgage is an extra consideration. What about high balances on credit cards? Do you have a lot of credit card debt? Are there high balances? What's the interest rate you're paying? It might be smarter to take that extra cash that you're thinking about putting towards the principal and pay down the credit card debt first.
Yeah, if you got 20,000 in debt and you're paying 24% on a credit card or 18% on a credit card, and you're paying 3% on your house, you should pay that on the credit card.
Yep.
Yeah.
Here's a reason to pay down the mortgage. You're paying mortgage insurance.
Mm.
If you're putting extra cash towards your mortgage, extra principal, you can look at that mortgage balance at some point in the future and ask the mortgage company to reevaluate the equity and get that mortgage interest, that mortgage insurance premium off of there. That could save you a lot of money over time.
Yep.
So that's a good reason to start paying down the principal. And you have to ask yourself if you're saving enough for retirement, right? If you haven't, then maybe you shouldn't be paying down that mortgage. Maybe the higher priority is putting some money away for retirement.
It seems like making that extra payment is committing the money to that, as opposed to having options when you're doing other things with it. So if you need to keep
you're not locking yourself in, obviously.
Right.
It's you still have discretion whether or not you're going to make that extra principal payment.
Yep.
Every month. Or you could take the middle ground. Figure out your expenses. Maybe change your spending habits. Free up some cash to address all of your goals. Put some extra money towards the principal. Make sure that you're saving adequately for retirement, and you're putting money away for your kids' education as well. That's the ideal approach, I think.
Yeah, a balanced approach, right?
Yeah, exactly. And by the way, there is the ability to recast your mortgage. Let's say that you inherited some money and you wanted to pay down the mortgage, and you didn't want to pay it off.
Mm-hmm.
A lot of mortgage companies, a lot of banks will allow you to, with the same terms, the same rates as the original mortgage, just recalculate your monthly payment based on a reduction in the principal because you pay off some of that principal.
Oh, I see.
As a lump sum. They call it recasting the mortgage. Something that you can consider as well.
Interesting.
Yeah, it's cool, huh?
Again, a lot more options and highly complex, and mistakes can be made. And by the way, you bring up questions that people haven't asked themselves when they're considering these things. That's the problem with financial planning a lot of times, is that there are questions you don't even know you should be asking.
Right.
Yeah.
Yep. Yeah. But this is a question that comes up a lot.
Mm-hmm.
And with today's interest rate environment, I can honestly say that a lot of times it just doesn't make a lot of sense to be paying down that mortgage. But for a variety of reasons, it could make sense for you. So that's something that we can talk about in that initial consultation.
Yeah, if you have a 3% mortgage or 3 to 4% mortgage, and you're using that as a deduction, and you're getting deductions on top of that, you're doing all right. There's probably better ways to spend the money that extra money that you're trying to put somewhere. Probably better ways to do it.
Yep, exactly.
Yeah.
And ways that could save you some more money in taxes too. That's another thing to consider.
Yeah.
Yeah. Hey,
opportunity cost. So what are you giving up by paying that? What are you getting off by paying off the mortgage?
Exactly. So the bottom line is we have to evaluate the opportunity costs, weigh those against each other, and decide what's the best thing for you. And everybody's circumstances are individual, really.
Yeah.
Everybody's circumstances are unique, so there's no one right answer in every case. And that's what you're going to get if you search it on Google.
Yeah.
Right.
Again, it's like doing your own appendectomy. I'm sure there's a YouTube video out there somewhere, but that doesn't mean you should do it.
I don't know if you do this yourself. I don't think you can get gangrene, but
well,
perhaps
financial gangrene.
Yeah, financial gangrene. Very good. Hey, so listen, we're going to take a quick break, and we're going to come back, and I've got this week's Talk Money Tip, and this week's Talk Money Tip is a follow-up from last week. You asked me a couple of questions. I actually have to make a correction because I gave some bad information. I have to correct that.
All right, excellent.
But it's a follow-up from last week's discussion about high deductible health insurance plans and HSAs or health savings accounts. So we're going to do that when we come back. We're going to take a short break. Please stay tuned.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back. Hey, Lou, last week you asked a question I couldn't answer during the show, and I wanted to research it and get back.
A little turnabout is fair play, huh?
And you asked me if you could, we talk about HSAs, health savings accounts. These are accounts you put money, you fund. You can always set it up if you have a companion high deductible health insurance plan, right? And so you can only put money in if you have that type of health insurance arrangement. You put the money in pre-tax, you pull it out for qualified medical expenses in order to, and you pull it out tax-free, right? If you use it for something else, there's a penalty,
Right?
and you pay taxes on it. And you asked me if you could pull that money out of an HSA to pay your health insurance premiums.
Yeah.
And the answer is no, you can't.
Yeah.
You cannot, right?
Yeah.
I did learn something that I didn't know that I want to share with you, but I also want to make a correction. And I said during that segment, I talked about having the money in there, getting to a certain age, and then having the ability to roll over your HSA to an IRA.
Yeah.
And I indicated that you could do that. You can't.
Hmm.
You cannot roll monies left in an HSA into an IRA account. However, once you reach a certain age, 65, you can't put money into. Once you reach Medicare age, you can't put money into an HSA anymore. You're prohibited from doing that.
Right.
But at that time, once you reach that age, you no longer have to use those funds for medical expenses in order to pull it out penalty free.
Yeah, see, I was wondering what the end result of this was if you started building up this HSA and making regular payments but weren't using it. At what point does the money become available to you?
So
wait
it would,
till 65?
Right. So it would make, yes, you do. So it would make sense penalty free, right? So you can use it tax free, right? So you have to pay tax. So you use it for medical expenses up until you're 65, and it's a tax free withdrawal and penalty free withdrawal. Once you reach age 65 Medicare age, then you can't put money in it anymore. But you can take it out for any purpose. You'll pay taxes on it.
Right.
If you use it for medical expenses, you don't pay taxes on it. If you pull it out and pay something else, you pay taxes on it, but no penalties. That's the way it works. It would make sense to be able to roll it into an IRA, but you don't have to. That's the bottom line. Because of the way it works, you really don't have to. It essentially becomes an IRA account once you reach age 65. But that's not this week's Talk Money tip.
Can I ask a question though? What's happening to the HSA in the meantime? Is it basically a bank account?
Yeah, it can be invested in a bank account. It can actually be invested in mutual fund type investments.
Oh, it can. So you can you can manage the money and have it working for you a little bit.
You can make it grow.
All right.
Yep, absolutely.
That makes more sense. Okay.
Yeah. But there is an insurance plan that you can use your HSA funds to pay the premiums. Long-term care insurance.
Yeah.
Yep. But the amounts that you can withdraw and pay for long-term care do vary by age. So if you're 40 or younger, you can withdraw up to $420 tax-free from an HSA. If you're 41 to 50, you can take out 790. If you're and by the way, these numbers change, and this is the 2019 numbers. If you're age 50 to 60, you can pull out 1580. If you're 61 to 70, you can pull out $4,000, 4,220. If you're 71 or older, you can pull out $5,270. Tax-free, penalty-free to pay for long-term care insurance. So this is if you have an HSA account and you've built up some money. This would be a way to save some money in taxes and get an important, critical insurance plan for long-term care.
Interesting.
Yeah. And those numbers increase by inflation, just like your contribution limits on retirement accounts will adjust for inflation over time. So do these numbers as well. So.
You started putting off those numbers at what, 40 years old?
40 years old.
Yeah.
Or younger.
Long-term healthcare insurance, is it term insurance?
No.
Or it's asset-based? Or it's
term insurance. It's there's a lot of different plans out there, and whether or not you can use your HSA to fund all of them, I don't know for sure. So want to make that disclaimer. But generally speaking, what they do is they pay long-term care insurance plans pay a daily rate, cover a day in a long-term care facility.
But I'm thinking of the 40-year-old who pays for a long-term health care coverage for 20 years until he's 60.
Yeah.
If he stops at 60, is he no longer covered, or is there
Depends on the plan.
It depends on the plan. Yeah.
Depends on the plan. Yep.
Yeah.
Yep. Some of them do have what they call non-forfeiture values, where you're covered for a certain period of time. Some of them actually will give you premium refunds. Some build cash values. There's a lot of different plans out there.
Again,
becoming a more
highly complex. Yeah.
Yeah, it's becoming more and more important too. But the bottom line is it's less expensive if you buy it at a younger age. I don't know if I'm going to convince a 40-year-old to buy long-term care insurance.
Yeah, that's what I was wondering when you brought up the 40-year-old. I was, why is a 40-year-old buying long-term health care insurance? But
they probably aren't. But
yeah,
this gives you the ability to take $420 out of your HSA to buy it.
Yeah,
They didn't want to ignore anybody. They wanted to include everybody.
Are there beneficiary systems for HSAs?
Say that again.
Is there a beneficiary system for an HSA? In other words, you've built up this money and you pass. Does it go to a spouse?
If it has death benefits, yes, as a beneficiary. Yeah.
Okay.
And some do. And some do have death benefits. Yeah. Depends on the plan.
Yeah. Another thing to watch for.
Yeah. Hey, we could have a whole show just on long-term care.
I can imagine.
Yeah. Hey, we talked about Medicare earlier, and I do want to promote next week's show. Edna Peters is going to be on, and she's a Medicare expert, and she's going to be talking about because this is the time of year where you get to change your plan, starting in October, ending in middle of October, I think, October 15th. You can start looking at and changing your plan for January of 2022. And so she's going to talk a little bit about what your options are, what to look for, that sort of thing. So we're going to have her on next week. So you definitely want to definitely want to tune in next week.
That'll be helpful for those of us approaching Medicare age.
Yes.
What are you laughing at? Stop
laughing. It would be, yes. Or if you already have, even if you already have Medicare, you can make changes. This is the time where you can make changes, evaluate different plans. And she's going to talk about what the rules are and what you can or can't do.
Well, that wasn't an either or. It'll be helpful for everybody. Medicare, I imagine, is another government system that's incredibly intricate. And
if your parents are on Medicare, this would be a good show for you because it's possible that you might have to help them make the decision.
Yes. That was an interesting time. I remember that. Yeah, that was an interesting time.
There you go.
It's important if you have parents approaching,
getting
on, you need to understand some of these principles too.
Yeah. Hey, if you want to get in touch with me after the show, dial the toll-free number, 877-475-2062. Send me an email, jeff@talkmoneyradio.com, or you could just send us a message right on Facebook. So until next week, please remember, good sound advice is much better than advice that just sounds good. Thanks, Lou.
It's a gas.